Every single thing you need to know about Bitcoin is inside this video. And even if you don't know anything about it, you will be able to follow through because every single video on Bitcoin Academy is 100% beginner friendly. Today, we will go over entire history, going through each year from beginning until now. So without wasting time, let's start with birth year, which is 2008. If you really want to understand Bitcoin, you have to go all the way back to 2008, not just to a technological beginning, but to a global moment of deep financial anxiety. This was the year that trust in the banking system completely collapsed. Lehman Brothers fell. Massive institutions went bankrupt. Ordinary people watched their life savings disappear overnight, while governments rushed in with trillion-dollar bailouts to keep the system afloat. It was during this financial storm, on October 31st, that a short 9-page document quietly appeared on a cryptography mailing list. The author called themselves Satoshi Nakamoto, and the title of the document was simple: Bitcoin, a peer-to-peer electronic cash system. There was no marketing campaign, no launch event, just an idea that would end up challenging everything we thought we knew about money. The white paper laid out a method for sending value across the internet without needing a bank or payment processor in the middle. That idea might sound simple now, but at the time, it was radical. Instead of relying on trust in institutions, it used mathematics, cryptography, and decentralized consensus. In just 9 pages, Satoshi proposed a complete redesign of how financial systems could work, where anyone, anywhere in the world, could send money to anyone else without asking permission and without the risk of fraud or double spending. And importantly, the timing was no accident. Embedded deep within Bitcoin's early code is a permanent message referencing a headline from the Times newspaper: Chancellor on brink of second bailout for banks. That wasn't just a timestamp, it was a statement of purpose. Bitcoin wasn't created out of curiosity. It was a direct response to the failures of the financial system. But who was Satoshi? That mystery only deepens the story. No one has ever definitively identified the person or group behind the name. Some believe it was a single brilliant programmer. Others argue it must have been a team. Theories have ranged from cryptographers like Hal Finney to academics like Nick Szabo, to even rumors involving the NSA or other intelligence agencies. Australian entrepreneur Craig Wright famously claimed to be Satoshi, but has never provided convincing cryptographic proof. Despite endless speculation, the truth remains locked away, possibly forever. And yet, from that small, anonymous beginning, an entire movement was born. Bitcoin wasn't just a new kind of currency. It was a challenge to everything centralized, a way to exit a system that had failed so many. And even though it would take years for the world to catch on, that quiet moment in 2008 would eventually reshape the entire global financial landscape. If 2008 was the spark that introduced the idea of Bitcoin, then 2009 was the year it came to life, silently, without fanfare, but with a message that would echo across time. On January 3rd, 2009, the first ever Bitcoin block was mined by Satoshi Nakamoto. This block, now known as the Genesis block, was more than just a line of code. It was the beginning of a new kind of financial system, one that didn't rely on central banks or governments, but on a decentralized network of computers running open source code. That first block didn't just mark the start of Bitcoin's technical existence, it also carried a clear political message. Embedded within it, written directly into the raw data, was a headline from the British newspaper The Times: Chancellor on brink of second bailout for banks. It was a quiet but powerful signal, a commentary on the broken legacy system, and a declaration of purpose for what Bitcoin aimed to replace. This Genesis block carried a reward of 50 BTC, but unlike later blocks, those coins were never spendable. Some believe it was a symbolic gesture from Satoshi, marking the block as something sacred, a starting point that should never be touched. Just days later, on January 12th, the very first Bitcoin transaction took place. Satoshi sent 10 BTC to Hal Finney, a respected cryptographer and one of the few early supporters of the project. That moment wasn't just a technical success. It was proof that value could be transferred between people over the internet with no bank, no third party, and no permission. It was a glimpse into the future, but the world wasn't paying attention. In 2009, Bitcoin didn't have a price. You couldn't buy it on an exchange. There was no Coinbase, no Binance, no mainstream media coverage. Bitcoin existed only in the corners of internet forums, among cryptography enthusiasts and digital idealists who saw something revolutionary in its design. It ran quietly, block by block, every 10 minutes, without stopping. A machine that no one could shut off, maintained by volunteers who believed in its vision. There was no roadmap, no guarantees, and no idea of what it would become. but the foundation was now set in stone, or in this case, in code. That first year was not about growth or headlines. It was about survival. The network was small, fragile, and vulnerable, but it worked. For the first time in history, a truly decentralized financial system existed, not in theory, but in practice. It was still just a baby, but Bitcoin had taken its first step, and history was already in motion. We reached topic number 3, and it is a significant one. Year is 2010, and Bitcoin has the price value for the first time in history. At some point, every invention has to leave the garage and step into the real world. For Bitcoin, that moment came in 2010, the year when it stopped being just a fascinating idea among cryptographers and finally gained a price. It was the first time this invisible digital currency was exchanged for something tangible in the real world. That moment is now legendary, and it involved something as ordinary as pizza. On May 22, 2010, a developer named Laszlo Hanyecz posted an offer in a Bitcoin forum. He would pay 10,000 BTC to anyone who could get him 2 large pizzas delivered to his home. At the time, Bitcoin didn't have a market value, so 10,000 coins sounded like a playful, generous amount, more like tokens in a game than anything of actual worth. But someone took him up on it. A user from England helped coordinate the purchase, and soon enough, 2 Papa John's pizzas were delivered to Hanyex's door in Florida. In return, he sent over the 10,000 BTC. It became the first documented real-world purchase using Bitcoin, and it gave Bitcoin its first price, about $0.003 per BTC. Today, those 2 pizzas would be worth hundreds of millions of dollars. That day is now celebrated every year as Bitcoin Pizza Day, a quirky but powerful reminder of how far Bitcoin has come. As this story spread among early adopters, something began to shift. People started to see Bitcoin as more than a science experiment. It had value, and when something has value, people begin to trade it. Soon, rudimentary markets started forming. Online forums hosted informal trades, and peer-to-peer exchanges emerged. Later in the year, a more formal exchange launched, MT Gox. Originally created to trade Magic the Gathering cards. Yes, really. MT Gox was repurposed into a Bitcoin exchange by a programmer named Jed McCaleb, who is one of the founders of Ripple XRP. The platform quickly became the central hub for Bitcoin trading and would later play a major role in Bitcoin's early rise and eventual scandal. But in 2010, it was a key milestone. Bitcoin now had a place where anyone could buy and sell it. Back then, things were still incredibly rough around the edges. Wallet software was basic, user interfaces were clunky, and security was an afterthought. But for the first time, Bitcoin had a market. It had users outside the original mailing list. It had a price people could look up. And with each new block mined, it was steadily building the foundations of a parallel financial system. This was the year Bitcoin made its debut as money, not just as a network or a concept, but as a currency someone used to buy dinner. And even though that dinner might have been overpriced in hindsight, the message was clear. Bitcoin had officially entered the economy. Everything was set. Now it was time to grow. And that brings us to topic number 4. By the time 2011 arrived, Bitcoin had already taken its first steps into the world. It had been mined, traded, and even used to buy pizza. But 2011 was the year it truly started to grow. And not just in terms of price, but in visibility, competition, and controversy. This was the year when Bitcoin crossed a major psychological milestone. 1 full Bitcoin was finally worth $1. It might not seem like much now, but back then, it was a big deal. It meant that Bitcoin, this strange internet money born out of a cryptography forum, was starting to be taken seriously. For the first time, people who had mined or traded Bitcoin early on were beginning to see real-world returns. But with growth came exposure, and with exposure came new risks and new players. As Bitcoin's price rose and its story started making waves online, the media began to take notice. Publications like Wired, Time, and Forbes ran their first pieces on the mysterious currency. They weren't always positive, but they were curious. The general tone was, what is this thing, and why is it gaining value? Bitcoin was becoming more than just a technical curiosity. It was entering the public conversation, but not all attention was welcome. This was also the year Bitcoin gained a controversial use case on the darknet marketplace Silk Road. There, Bitcoin became the primary currency for anonymous transactions, including the purchase of illegal drugs. For some, this was proof of Bitcoin's power, a decentralized currency that couldn't be censored. For others, it was a warning sign of what could happen when money existed beyond government control. Either way, The story of Silk Road and Bitcoin became intertwined in the public eye, and it sparked intense debate about the purpose and future of digital currency. Meanwhile, the crypto ecosystem itself started to evolve. Inspired by Bitcoin's open-source nature, developers began creating their own digital currencies, alternative coins or altcoins. Among the earliest was Namecoin, designed to decentralize domain name registration. Then came Litecoin, launched in October 2011 by Charlie Lee, a former Google engineer. Litecoin promised faster block times and a different hashing algorithm, positioning itself as the silver to Bitcoin's gold. Peercoin soon followed, introducing a new proof-of-stake concept. Each of these projects aimed to solve what some saw as limitations in Bitcoin or to experiment with new features entirely. By the end of 2011, it was clear that Bitcoin had sparked a movement. It wasn't just a single coin anymore. It was the foundation of an entirely new asset class, one that was rapidly diversifying, innovating, and yes, drawing attention from governments and regulators. Bitcoin had reached its first real milestone, becoming worth $1. But what that dollar represented was far bigger. It was proof that a decentralized currency could survive, adapt, and grow, even in a world that didn't fully understand it yet. We reached topic number 5, and if you like the value you are getting, I would kindly ask you to subscribe and like the video. Getting back to topic. By 2012, Bitcoin had survived its earliest tests and was no longer just a novel experiment among technologists. This was the year it began to mature. It didn't happen overnight, and it didn't make global headlines just yet, but the groundwork was being laid for the future of an entire industry. One of the most significant developments in 2012 was the formation of the Bitcoin Foundation. Its mission was straightforward: to promote and standardize Bitcoin, provide education, and fund development. This marked the beginning of an organized effort to present Bitcoin to the wider world in a more structured, credible way. Until then, Bitcoin had been purely grassroots, shaped by a decentralized swarm of developers and enthusiasts. The Bitcoin Foundation brought in more formal leadership, with notable early members including Gavin Andresen, one of Satoshi's direct collaborators. The idea was to ensure Bitcoin's continued growth and to provide some level of coordination without compromising the network's decentralized nature. But the real highlight of 2012 came near the end of the year. Something that would become a recurring event in Bitcoin's lifecycle, the halving. On November 28, 2012, Bitcoin experienced its very first halving event. This is a built-in feature of Bitcoin's code, where the number of new Bitcoins generated with each block is cut in half. Before the halving, miners received 50 BTC per block. After the event, that reward dropped to 25. This reduction in supply was a crucial moment because it introduced a kind of programmed scarcity, reinforcing Bitcoin's narrative as digital gold. Unlike fiat currencies, which can be printed endlessly, Bitcoin's supply is capped and becomes increasingly harder to produce. It was at this moment that people started to realize Bitcoin wasn't just a currency. It was also an economic experiment in controlled issuance and deflationary pressure. At the time of the first halving, Bitcoin's price hovered around $12. It was still extremely volatile, still not widely understood, and still flying under the radar of traditional finance. But those who were paying attention began to notice a pattern. Just a year later, by the end of 2013, Bitcoin would climb to over $1,100. While many factors contributed to that explosive rise, the halving was a major catalyst. It was the first proof that Bitcoin's monetary policy could drive real economic effects. And it also gave birth to one of Bitcoin's most powerful memes: number go up. With supply cut in half and demand slowly rising, simple economics started doing its work. 2012 wasn't about hype or price explosions. It was about building. It was about creating the institutions, narratives, and mechanisms that would shape the next decade of Bitcoin's evolution. For the first time, there was a serious attempt to bridge the gap between Bitcoin's raw code and the real-world systems it was designed to challenge. The first halving wasn't just a technical milestone, it was a rite of passage. And from that moment forward, every 4 years, the halving would become a countdown for believers, a timer for cycles, and a powerful reminder that Bitcoin plays the long game. Everything was going well, but then first problems came, and they bring us to topic number 6. At the start of 2013, Bitcoin was trading at around $13. For those who had been involved early, it had already felt like a miracle to watch this open-source project, born out of the ashes of the 2008 financial crisis, gain value and traction. But no one was prepared for what came next. Over the next 11 months, Bitcoin would experience its first parabolic rise. Fueled by growing media coverage, rising adoption, and the narrative of a new kind of money, Bitcoin's price surged to over $1,000 by the end of the year. That's nearly a 100x increase in just 1 year. It was a rush of excitement, greed, and disbelief. Suddenly, people who had bought Bitcoin for fun or mined it on their laptops were sitting on small fortunes. The world started paying attention, not just developers and libertarians, but investors, speculators, and governments. Much of the trading activity was centered around a single platform, Gox, which by then had become the largest Bitcoin exchange in the world. Based in Japan, Gox handled around 70% of all Bitcoin transactions globally at its peak. But even as prices soared, cracks were already forming. Users complained about withdrawal delays. Technical issues plagued the exchange, and behind the scenes, a disaster was brewing, one that would shake the community to its core the following year. But in 2013, the most immediate challenge came from overseas, from China. Bitcoin's meteoric rise didn't go unnoticed by Chinese investors, and a large portion of new demand was flowing in from China-based exchanges. The Chinese public was fascinated by the concept of an alternative to the yuan, especially one that was outside of government control. For a while, Bitcoin flourished in China, until December when the Chinese government intervened. The People's Bank of China issued a ban prohibiting financial institutions from handling Bitcoin transactions. It wasn't a total ban on Bitcoin, but it was enough to send shockwaves through the market. Prices plummeted, panic spread, and the narrative shifted from Bitcoin is the future of money to is this thing even legal? To make matters worse, Gox began freezing withdrawals that same month. Users couldn't access their funds. Rumors of insolvency began to circulate. Trust, which is hard-won in any financial system, especially a decentralized one, started to erode. Yet, in spite of all this chaos, 2013 was a turning point. It was the first time the world truly saw what Bitcoin could do, not just as a technical innovation, but as an economic force. The bubble may have burst, but it left behind a trail of interest, investment, and belief. New users had entered the space. Entrepreneurs began thinking seriously about crypto businesses. And most importantly, Bitcoin had proven it could capture the global imagination. And if you thought the trouble was over, you'd be wrong. Because what came next in early 2014 was a crisis that shook Bitcoin to its very foundation, a moment that not only tested the resilience of its technology, but also the faith of its entire community. The year began with optimism, as Bitcoin was still basking in the glow of its first big breakout. But that optimism would be short-lived, because in February, the unthinkable happened. Gox, the largest and most influential Bitcoin exchange at the time, suddenly went offline. For years, Gox had been the main gateway into Bitcoin for thousands of users around the world. At its peak, it handled over 70% of all global Bitcoin transactions. It was based in Japan and had grown quickly, but not responsibly. Its infrastructure was weak, its leadership inexperienced, and its internal systems riddled with vulnerabilities. Users had already begun complaining about withdrawal delays in late 2013. Then, without warning, Gox suspended all trading, shut down its website, and filed for bankruptcy. The bombshell soon dropped. The exchange had lost 850,000 Bitcoins, most of them belonging to customers. At the time, that was roughly 6% of all Bitcoin in existence. The cause? A combination of poor security, negligence, and possibly inside theft. Either way, the damage was done. The Bitcoin price, which had hovered near $1,000, crashed to around $300. The fallout from Gox was massive. For many, this was their first real introduction to the idea of self-custody. The notion that not your keys, not your coins, wasn't just a slogan, but a survival strategy. Trust in centralized exchanges was shattered. People realized that while Bitcoin itself may be decentralized, the platforms used to access it often were not. This event planted the seeds for the rise of hardware wallets, cold storage solutions, and a broader culture of security awareness within the crypto community. But the Gox collapse wasn't the only thing shaping 2014. This was also a year of reflection and rebuilding. Developers and early supporters had to ask themselves hard questions. Could Bitcoin survive this public disaster? Would regulators crack down harder? Would users lose faith? Yet, amidst the turmoil, the network never stopped running. Blocks kept being mined every 10 minutes. Transactions continued to be confirmed, and the code remained unbroken. In a strange way, that stability became a quiet reminder of what Bitcoin was designed to do: operate without a single point of failure. It was during this time that people began to differentiate between Bitcoin, the technology, and the platforms built around it. The collapse of Gox didn't kill Bitcoin. In fact, it had the opposite effect. It forced the ecosystem to mature. It taught harsh lessons about risk, custody, and responsibility. And for those who stayed, it became a moment of clarity, a painful but necessary step on the road to true decentralization. By the end of 2014, Bitcoin had lost much of the spotlight it had gained the year before. Prices were down, media attention had faded, and critics declared once again that Bitcoin was dead. But the core community, the builders, the believers, the ones who understood the bigger picture, kept going because they knew that this was bigger than one exchange, one country, or one year. Bitcoin wasn't just surviving, it was adapting. And that, more than anything, is what would carry it forward. And it carried us to topic number 8. By 2015, Bitcoin was still recovering from the disaster of the Gox collapse. Confidence had been shaken, and prices were nowhere near the highs of 2013. But beneath the surface, something more important was happening. Developers, users, and miners were trying to figure out the future. Not just how to grow Bitcoin, but how to grow it without breaking the principles it was built on. And that led to one of the most critical debates in Bitcoin's history, the block size controversy. The question was simple. Bitcoin blocks had a limit on how much data they could hold, and that limited how many transactions could be processed. As Bitcoin became more popular, the network was starting to hit that limit. Transactions were taking longer, fees were rising. Some people believed the answer was obvious. Raise the block size. Allow more transactions in each block, and you solve the problem. But others pushed back. They argued that raising the block size would make the blockchain grow too large and eventually make it difficult for regular users to run a full node. That would reduce decentralization. And to them, that was a much bigger problem than high fees. This disagreement sparked what became known as the block size war. Multiple new versions of Bitcoin software were released that tried to change the block size limit. Projects like Bitcoin XT, Bitcoin Classic, and Bitcoin Unlimited all had different ideas for scaling, but none of them were adopted by the majority of the network. What this period really showed was how difficult it is to make changes to Bitcoin. Even if many people agree, unless there is clear consensus, the network refuses to move. During this time, the second Bitcoin halving also occurred. On July 9, 2016, the block reward dropped from 25 to 12.5 BTC. Just like the first halving, it showed that Bitcoin's monetary system was working exactly as designed. Fewer new Bitcoins were entering circulation, and that scarcity was starting to matter more and more. So while this 2-year period might seem quiet on the surface, it was anything but. It was the moment Bitcoin had to decide what it wanted to be: faster and cheaper at any cost, or slower but stronger in its core principles. In the end, Bitcoin chose to stay small, for now. But the debate was far from over. It was only the beginning of a larger conversation about how Bitcoin would scale in the years to come. All right, moving to topic 9, which will bring major spotlight. By the time 2017 began, Bitcoin had already been around for nearly a decade, quietly building momentum. But this was the year everything changed. Bitcoin wasn't just a niche interest for developers or a playground for early adopters anymore. It was going mainstream. It was the year of civil war in the community, major upgrades to the network, and a price surge that would capture global attention like never before. But all of that didn't come easily. It came with serious growing pains. At the center of the chaos was the ongoing block size debate. The arguments that had divided the Bitcoin community for years finally reached a breaking point. After years of tension, a split became inevitable. On August 1st, 2017, Bitcoin officially underwent a hard fork. The result was Bitcoin Cash, a separate cryptocurrency created by those who supported larger blocks. It was a dramatic moment that felt like a family breaking apart. Suddenly, there were two competing visions for what Bitcoin should be. But the original Bitcoin, now more united around the idea of small, secure, and scalable steps, pushed forward with its own upgrade. That upgrade was segregated witness, better known as SegWit. This change didn't raise the block size, but it optimized how data was stored in each block. It was a major breakthrough that increased transaction capacity and laid the foundation for further innovations, including the Lightning Network, a solution designed to allow fast and cheap transactions off-chain. SegWit was activated just days after the Bitcoin Cash split and marked a critical moment where the Bitcoin community proved it could evolve without abandoning its principles. While the technical side of Bitcoin was transforming, so was public awareness. The second half of 2017 saw a wave of media coverage and global interest. Bitcoin was no longer a curiosity. It was a financial phenomenon. Celebrities, hedge funds, and even your neighbors started talking about it. The price reflected the hype. In December, Bitcoin hit an all-time high of $19,783 on Coinbase. It was a jaw-dropping moment for everyone who had been following the journey from its early days. What once cost fractions of a penny was now being compared to gold. But the price wasn't the whole story. What made 2017 so important was that it forced the community to face tough questions, make hard decisions, and adapt under pressure. It was the year Bitcoin faced its first civil war and survived. It proved that no single person or group controls it, that even when divided, the network can hold. And in the process, it earned a level of attention and legitimacy that no one could ignore anymore. And as the saying goes, the higher they fly, the harder they fall. Same goes for Bitcoin, and we will explore it in topic number 10. If 2017 was the year of dreams, 2018 was the year of consequences. The hype had reached a fever pitch in December 2017, with Bitcoin touching nearly $20,000. But markets don't climb forever, and what goes up, especially that fast, often comes crashing down. 2018 marked the beginning of what would be known as the crypto winter, a brutal bear market that wiped out billions in market value, tested the faith of investors, and separated speculators from true believers. In just a few months, Bitcoin's price plummeted, falling to around $3,000 by the end of the year. That's over an 80% drop. And it wasn't just Bitcoin. The entire crypto market followed. Ethereum, Ripple, Litecoin all saw their prices crash. Many projects that had launched during the 2017 initial coin offering, ICO boom, promising to revolutionize everything from healthcare to real estate, simply vanished. It was like the dot-com crash, but for blockchain. Dozens of ICOs turned out to be scams. Others were poorly managed. Some never launched a product at all. Regulators stepped in, especially the U.S. Securities and Exchange Commission, or SEC, cracking down on illegal fundraising and securities violations. But perhaps the most defining feature of 2018 was the media narrative. Headlines declaring Bitcoin is dead were everywhere. In fact, it was declared dead over 300 times just that year. Critics said it was proof that crypto had been a bubble all along, just a speculative fad that had finally popped. But those closer to the space knew something else was happening beneath the surface. While prices were crashing, development didn't stop. If anything, it intensified. Teams went heads down building infrastructure, better wallets, secure custody solutions, and scaling tools like the Lightning Network. The Bitcoin protocol itself remained untouched by the chaos. Blocks continued to be mined, the network remained secure, and long-term supporters kept the faith. In many ways, 2018 was like a forest fire, painful, but necessary for growth. The scams were cleared out, the hype was stripped away, and what remained were builders, developers, and investors focused on the long game. Crypto winter wasn't fun, but it was vital. It revealed the weaknesses in the ecosystem, from poor security practices to unsustainable business models. It reminded people that Bitcoin isn't a get-rich-quick scheme. It's a technological and monetary revolution. And like all revolutions, it has cycles. Hype, crash, rebuild, repeat. By the end of 2018, the tourists were gone. The market was cold. But those still standing were stronger, wiser, and ready for the next chapter. Because if Bitcoin had survived this storm, it was clear. It wasn't going away. It was just getting started. And that brings us to topic 11. After surviving the brutal crypto winter of 2018, the Bitcoin ecosystem entered a quieter, more focused phase. One defined not by price action or media hype, but by infrastructure building and institutional curiosity. Between 2019 and 2020, the spotlight shifted from retail investors and speculative bubbles to long-term strategies, serious financial players, and maturing technology stacks. By 2019, the panic had largely subsided. Bitcoin's price had stabilized between $3,000 and $5,000 early in the year, and steadily climbed back above $10,000 by mid-2020. But more important than price was the shift in who was paying attention. This was the period when institutions began stepping in, not with empty promises or ICO white papers, but with real capital, regulated products, and long-term vision. One of the major milestones was the launch of Bakkt, a Bitcoin futures exchange created by Intercontinental Exchange, the company behind the New York Stock Exchange. Unlike earlier futures products, Bakkt's contracts were physically settled, meaning they delivered actual Bitcoin, not just cash. This gave investors more direct exposure and signaled rising demand for secure, regulated Bitcoin investment avenues. At the same time, legacy financial firms started quietly building out crypto divisions. Fidelity Digital Assets launched its custody services, giving institutional investors a secure way to hold Bitcoin. Grayscale, a digital asset investment firm, began attracting significant inflows into its Bitcoin Trust GBTC, especially from hedge funds and family offices looking for exposure without having to manage private keys. Meanwhile, the narrative around Bitcoin began to shift again, this time toward macroeconomic themes. In 2020, the COVID-19 pandemic triggered unprecedented economic responses around the world. Central banks printed trillions of dollars in stimulus, interest rates dropped to near zero, and inflation fears started rising. Against this backdrop, Bitcoin's fixed supply and decentralized nature looked more appealing than ever. It wasn't just internet money anymore. It was increasingly seen as digital gold, a hedge against traditional money devaluation. Perhaps the biggest moment in this transition came when MicroStrategy, a publicly traded business intelligence company, announced in August 2020 that it had converted a significant portion of its corporate treasury, over $250 million, into Bitcoin. CEO Michael Saylor described Bitcoin as a dependable store of value in a time of monetary chaos. This move was bold, but it started a trend. Soon after, Square, led by Jack Dorsey, and Tesla, under Elon Musk, would follow with their own Bitcoin investments. But MicroStrategy was the first to open that door. In hindsight, 2019 and 2020 were not quiet years at all. They were pivotal. These 2 years laid the foundation for Bitcoin's next bull run by transforming it from a retail-dominated asset into a serious part of institutional portfolios. Infrastructure improved, narratives evolved, and adoption deepened. Not with hype, but with conviction. The Wild West of crypto was still present, but the frontier was beginning to look more like Wall Street, and Bitcoin was no longer the outsider. It was becoming part of the global financial system. Quietly, steadily, the next chapter was being written. And that next chapter brings us to topic number 12. On May 11th, 2020, Bitcoin underwent its third halving event, cutting the block reward from 12.5 to 6.25 BTC. While halving events are part of Bitcoin's built-in monetary schedule, this one hit differently. It occurred during a global monetary crisis, reinforcing Bitcoin's narrative as a hard asset. Supply was tightening while global liquidity was rising. The macroeconomic contrast couldn't have been bigger, and it became one of the key forces behind the next wave of adoption. With the groundwork already laid by previous years of infrastructure building, the network was ready. Exchanges, custody services, and institutional-grade products were mature enough to handle what came next. Demand from traditional finance grew stronger, and Bitcoin found itself positioned not just as a speculative asset, but as a hedge against uncertainty. By early 2021, momentum was impossible to ignore. Bitcoin surged past its previous high, breaking through 20,000, then 30,000, and finally reaching 64,863 on April 14th. This wasn't driven by retail frenzy alone. It was fueled by deeper confidence from a broader base of investors, analysts, and financial institutions. Later that year, the world watched as El Salvador took the bold step of becoming the first country to adopt Bitcoin as legal tender. It was a historic moment that marked Bitcoin's entry into sovereign monetary policy. The experiment came with challenges, including volatility and pushback from international organizations. But the message was clear. Bitcoin had evolved from a software experiment into a geopolitical force. The period between 2020 and 2021 marked a true transformation, not just in price, but in perception. Bitcoin had become something bigger, a tool for financial resilience in a world where central bank actions were becoming increasingly unpredictable. It no longer needed to prove it could survive. It had to prove it could lead. And once again, we must crash in order to rise again. Which brings us to topic 13. After every meteoric rise in Bitcoin's history, there's almost always been a reckoning, a crash, a correction, a moment where the hype collapses and reality sets in. And that's exactly what happened in 2022. Coming off the highs of the previous year, optimism was everywhere. Bitcoin had hit an all-time high, institutions had joined the movement, and even nation-states were testing adoption. But the crypto world still had a dangerous vulnerability: over-reliance on centralized platforms. And in 2022, that flaw would be exposed in the most brutal way possible. It started with the collapse of Terra's Luna and UST ecosystem, a so-called algorithmic stablecoin that promised to maintain its peg to the dollar through code alone. At one point, it was worth tens of billions of dollars. But when confidence cracked, the algorithm failed to hold its value, causing a complete death spiral. The collapse vaporized wealth almost overnight, destroying not only the token's value, but also trust in the broader DeFi landscape. That was just the beginning. The fallout spread to other firms that had been heavily exposed. Celsius, a major crypto lending platform, froze withdrawals and declared bankruptcy soon after. Then came Voyager, another crypto brokerage that couldn't withstand the pressure. And the biggest blow of them all came in November 2022, when FTX, one of the most well-known and widely used crypto exchanges, collapsed in spectacular fashion. FTX had been seen as a rising star. Its founder, Sam Bankman-Fried, was featured on magazine covers, spoke at global conferences, and lobbied policymakers. But behind the scenes, the company had allegedly misused customer funds and run a tangled web of risky financial schemes. When the truth began to unravel, users scrambled to withdraw their funds, only to find that billions were missing. In just a matter of days, FTX went from being a global giant to filing for bankruptcy, and Sam Bankman-Fried was arrested soon after. The crypto world was left stunned. Trust in centralized exchanges, which had already taken a hit years earlier with Mt. Gox, was once again shattered. Bitcoin wasn't the cause of any of these failures. In fact, the Bitcoin network continued to run flawlessly, but it was affected nonetheless. The price dropped sharply, falling to around $15,500, its lowest point in over 2 years. Sentiment turned bearish. Headlines declared the end of crypto. Regulators around the world, especially in the United States, seized the moment to push for stricter controls. The industry braced for another long winter. And yet, as always, Bitcoin didn't die. It endured. Those who had been through previous cycles understood the pattern. Excesses get cleared out, the market gets humbled, and slowly, the rebuilding begins. 2022 wasn't just a bear market. It was a purge, a painful but necessary reset. It reminded everyone why Bitcoin's core values, decentralization, transparency, and verifiability matter more than ever. Trust in platforms may falter, but trust in math and open code remained unbroken. After every winter comes a spring, and for Bitcoin, that spring began in 2023. But this wasn't just a recovery in price. It was a renaissance of innovation, regulation, and renewed institutional focus. The trauma of 2022 had left scars, but also clarity. The industry realized that real progress couldn't be built on hype, speculation, or centralized failures. It had to be rooted in transparency, verifiability, and open networks. And as we entered 2023, Bitcoin quietly started climbing back, not just on charts, but in the minds of investors, developers, and regulators alike. One of the most fascinating developments early in 2023 came not from Wall Street, but from the Bitcoin protocol itself, or rather, what people began building on top of it. In January, a developer named Casey Rodarmore launched the Ordinals protocol. It allowed users to inscribe data, including images, art, and even code, directly onto individual Satoshis, the smallest units of Bitcoin. In effect, it gave rise to a form of NFTs on Bitcoin. This was a huge shift in perception. Until now, most believed Bitcoin was purely for money, while Ethereum handled experimentation. But Ordinals opened the door to creativity, culture, and collectibles on Bitcoin's base layer. Some loved it, others hated it. But either way, it proved that Bitcoin wasn't standing still. Later that year, Casey returned with another innovation, Runes. Activated on April 20th, 2024, the exact same day as Bitcoin's fourth halving, Runes introduced a new token standard on Bitcoin. This was significant because, unlike Ethereum's ERC20 tokens, Bitcoin had never been known for supporting meme coins or token ecosystems. Runes changed that. For the first time, Bitcoin became home to its own meme coin mania. Some saw it as a distraction. Others saw it as the beginning of a broader, more flexible Bitcoin ecosystem. But there was no denying it. Bitcoin had started evolving again, not just in ideology, but in functionality. And while all of this was happening, institutions were quietly preparing a different kind of revolution, one based on regulation and legitimacy. After years of rejection, the US Securities and Exchange Commission finally approved spot Bitcoin ETFs in January 2024. 11 of them, BlackRock, Fidelity, ARK Invest, some of the biggest financial names in the world, now had direct exposure to Bitcoin through regulated investment vehicles. This was monumental. It meant pension funds, insurance companies, and conservative investors could now access Bitcoin without touching a wallet, downloading a seed phrase, or learning about block explorers. And that changed everything. The result? Bitcoin surged to a new all-time high, hitting approximately $73,000 in March 2024. But unlike the bull runs of 2013, 2017, or 2021, this one felt different. It wasn't driven by memes or mania. It was driven by macro trends, professional investors, and hard economic reasoning. Bitcoin was no longer just an alternative. It was becoming a serious contender in the global financial landscape. By mid-2024, the network had completed its fourth halving. The block reward was now 3.125 BTC. And yet, despite the lower issuance, miner revenue remained strong thanks to increased on-chain activity from ordinals, runes, and broader adoption. Layer 2 networks like Lightning were expanding quietly in the background, making Bitcoin payments faster and cheaper than ever. Bitcoin wasn't just surviving, it was thriving on every level: protocol, culture, infrastructure, and price. So what was 2023 and 2024 really about? Not just recovery, not just redemption. These were the years Bitcoin began to step into maturity. The cycles of boom and bust had forged resilience. The innovations showed it could evolve, and the institutions proved they could no longer ignore it. Bitcoin had been battle-tested, and it came out sharper, stronger, and more relevant than ever. And we finally arrived to present time and our last topic for today. On the global stage, Bitcoin has entered a new era of political and institutional relevance. More payment processors and fintech companies support it than ever before. In some countries, it's accepted by major retailers and even used for payroll and remittances. Governments are watching closely, some with interest, others with concern. But one thing is clear: Bitcoin is not going away. Spot ETFs have normalized its presence on traditional financial markets. Pension funds are allocating small percentages to it. Central banks, while not adopting it, are at least factoring it into risk models. That alone marks a seismic shift from the early days of being dismissed as magic internet money. And there are tons of strong statements suggesting Bitcoin might become part of federal reserves. And if leading economy, which is US, does it, most likely every other country will follow. And finally, for the people who have been here since the beginning, the ones who mined on laptops, debated block sizes, and held through winters, 2025 is a kind of vindication. Bitcoin has outlasted countless doubters. It has grown up, not by changing its core principles, but by proving their value over time. It's not perfect, it's not finished, but it is alive and more relevant than ever. So, where does Bitcoin go next? No one can say for sure, but one thing is certain: this story is far from over. If the last 17 years have taught us anything, it's that Bitcoin will continue to evolve, continue to surprise, and continue to challenge the way we think about money. And whatever comes next, it will be built on the foundation laid by every single block, mined every 10 minutes since 2009. And by staying until the end, you prove to be really keen on educating yourself about world of cryptocurrencies. If that is the case, I would suggest watching one of these two videos you see on the screen right now. Let me know your thoughts in comment section. And if you found video valuable, don't forget to like, share, and subscribe to the channel. See you in our next video.